Hello friends, let's have a look at the entire non-weighted market cycles based on pure price. What you're looking at is 4 cycles. Took a picture of this. This is 200 period moving average based log normal return of each stock which is not weighted across the market. And how far have they diverged from 200 period moving average? So think about a stock which has 200 MA on it, SMA, XMA, HMA, WMA, it doesn't matter. So this is simple moving average. So how far are you from that 200 mean? And then we do this for all the stocks in S&P, for all the stocks in NASDAQ, and all the stocks in NYSE, and we normalize the results. Log normal results are then treated as a non-weighted synthetic index. So think about Apple, Tesla, Microsoft, carrying all the big, huge 4 or 5 pillars of S&P moving the market most of the time. They may be independent movers. So if you don't take the weightage and each one is given equal weightage and how far are they diverging from 200 period moving average, we have accomplished some cyclic bias. Now this is done on 200 moving average basis. This is done on the 50 moving average basis, 20 moving average basis, 10 moving average basis. This is simply S&P chart to show you the relationships. This is also S&P chart to show you visually how the bigger cycles are working. Okay, this is what we are looking at. Now, if you look at the historical highs and lows, we start with 200 and see where are we in the market cycle, entire market cycle, multi-year market cycles. Now, it may not be of any interest to most folks because if you have reached this low when everything is below, the panic is extreme, everything has been sold off, everything is below 200 moving average, everything, not the index, independent stock in a normalized fashion. Typically, we'll see a bottom in the market. And you can see here, we made 30-40% returns on all these big cycles. We beat hedge funds for a reason, because this was the reason. But we can track it. So we can at least get the same performance as top hedge funds. Trying to get from X input to 10X input is a different game altogether. So this is not designed to tell you anything of such nature. This is multi-year cycle. So multi-year cycles right here. This was a panic low. 327 was the low. October 7 was the low. That gives you some idea. End of, Now this doesn't mean once you get the low, the market is going to turn. This is showing the shifting of the cycles. It is not showing actual everything is going to shift right now, tomorrow. No. It may take a while. So, for example, it may reach now everything in S&P 500. All of them are above 500. This is you can see on the right side. It still kept going. That means everything is in a high boost situation. If you see S&P, it still went much higher than that, right? It went up still more $10 before it started turning, cracking. So this is just telling you the major shift, and you may be off by a couple of months. So it was saying, okay, some short is coming, and finally it came. And then it's saying some long is coming. Big long is multi-year cycles are coming. Multi-year cycle. This was around 2019, January, end of 2018, or late early part of 19. So these are, we can see obviously you only got 1, 2, 3, 4 signals for the entire shifts in the market sentiment. Now, to refine it further, we go to 50. Same ideas, same concept, same calculations, same index calculations. But now we're going into deeper, a little bit more refined cycles within cycles within cycles within cycles. So 50. Now, if you're expecting a turn, now these are if you see the RSI calculations, right? We do the same thing. We pin the values and make it oscillate between 0 to 100. Around 80, you will start seeing some shifts happening already. So now let's look at this top. This is what I was saying, right? So the top was expecting the top is coming, but you're getting some cracks already happening on the S&P. You can see on this 60-minute chart, so crack is coming. Then it goes up and the cracks is coming, right? This is where we have shorter cycles. But you can see some crack was expected. Market is on 80 and we got some crack. Now this small crack lasted for 2 weeks, and as an option premium collector, it's good to know, right? Same thing here. Some crack is coming, so be cautious. That means you can hedge your sold puts. Same thing here. Some crack is coming. Now this is 50, right? 50 may, again, our idea is to that if all the now within this momentum cracking on the multi-year cycle, so all the rallies can be sold, right? If that is the intention of the game, if that is a game being played, so sell it, right? So I think this is what these are. Now, if you look at the current state of situations, now you can see market is going up and down in sideways action. Now the cycles are much more cleaner when your biasing on the one side is jamming in a certain way like this. Like, if they were not crack, if these cracks are happening, but if they're still not working out the way we're expecting, like it's not going to be a big, huge month high and low perfectly, right? This is not what it is. It is telling you the market sentiment. And finally, the crack came, and you can just see here the crack came at this point. At this is called the excitement phase, and the cracks start happening. People start noticing, and then you can see the cracks are getting bigger and bigger and bigger. Again, it's happening at the 70 or higher level up. So this is what it is showing the where the shifts are happening. The economical shifts are happening, cyclic shifts are happening, and then this year from 10, you can see here 8/16/22, all the way till October till December, then again some crack, and then end of December rally all the way till 2/2, which I think that's what I was saying in the implied volatility band also, that these are the rallies, same description of the entire market but done differently. One is done through volatility, one is done through log normal returns of the entire denormalized unweighted index. This is synthetic values, but there's a correlationship. So this is where we are now. If you look at where we are in terms of huge cycles, it doesn't tell us any bias. I want to be in the extreme so I can start shifting my bias. I want to sell puts. I want to do deep calls and deep puts money and make a synthetic straddles, or you can just keep buying stocks. Either way, but as a premium collection candidate, we need to look into some cycles so to help us protect. Now here, 2 weeks we were able to protect from the smashes because of these reasons. Now this may not be enough. Further, what we have to do is dig deeper into 20 period cycles. Now same logic, same calculations, but done, the mean divergence is happening from the 20 moving average, and we're converting this into cycles and oscillations. So right here around, as you can see, end of January, we reached the state of smash and we got a smash. That's not going to pin the days. This is a cycle. You can see here, you got this big move all the way here. Good profits. Smash came. Here also big long moves. There are cycles which are getting pulled back within this as well, but overall bias, that means here, pull back and draw a trend line, pull back, and just pivot, whatever baseline technical analysis so we can do. But ultimately, what is driving the market is this. these cycles from because the big players are looking into this, right? And then they're aware of this, what's going on. So there we are, and this is where I think the short came in. So if you look at the short, I think we already saw the short. So now if you're in the short cycle, now see if the two tops came together, 50 and 20, then perfect. I mean, now we're looking for definitely some push is coming, and it came. This is like quite a big of push. It's like almost 900 ES points, or we can say C 360, $90 in S&P times 10 is 900, right? So but this was known, right? Bias is always known. Here, the bias may not be correct, but we can have some bias. And here's the bias for long. Now let's see what happened in S&P. Let me squeeze this so we can see a little more data. So that's, I think, market generated. Can I do that? So let me change the time frame to maybe to 4 hours. Maybe make it 2 hours. Let's make it 4 hours. Okay. So we're just looking at the impact of this logic. We are trying to reach a state where we can zone and do same thing with stocks. Their run-ups and run-downs. And obviously they may diverge from the market itself, which we are aware of. So right, this is now is much more clear to see. Now you can see the 20, and now the same thing in the 10. This is again refining it. Cycles within cycles within cycles within cycles. If all the cycles are at the peak or trough, we know this momentum is behind it, right? That's all there is. And you rose this momentum, and you were happy here. There was a not unhappy there such situations, and then same thing. Let's look at this later on the 50. Stay on this. Sorry, the 50 and 20 and this 10. Everything is on the top. We're gonna hit down, right? Same thing here. Everything is on the bottom. Look at the 50. Look at the 20, and look at this 10. We're gonna go up, right? It doesn't give you the pinpointed day or the hour, which we can, but not with this technology. Overall bias. So we were discussing just not having the bias or no. Can we have the bias? Yes, we can have the bias, and we have to see the impact. Now this is entire market bias. Now here you can see this is top, this is top. We already saw that, right? So they all came down, came up, came down, came up, right? So big cycles. Now from this is 1 month cycle, half a month cycle. It's already 1 month. Yeah, 1 month here, 1 month here, month and a half here, right? What is it? So this is entire 1 month here. Almost 5-6 weeks here, 5 weeks here. So we're expecting something is going to happen. Why? Because we're going to see here the cycles are now tipping in the bottom side on the 10 and 50. Now 50 is not telling us anything. It is not in the extreme. I like it to have it on the bottom for a real big move. Now it can. This is not gonna give us any push from either side. It can just probably let it rally a little bit, and then it might either follow through. As you can see, it's creating ascending triangle on the cycle. If you just put the cycles, trend line at the bottom. Where is trend line? Here, right here. Oops, on this one. I think it froze. So I hope it makes sense that having this as the foundation framework where we are heading within the next couple of weeks might add some value, which we need to track and see. Right now, the 10 and the 20 are looking little. They want to run up. And if they run up, we can just see where they're going to go. Now, this is where we can use our market maker, market target, as we have done for the earnings, and see where they're going to go. So most likely, you can just think logically, this retest is an option. And then if they break through, the trend line is coming. I don't know what happened, it just froze. Sorry about that. So this is where we are. Oh, it is working. Sorry, I apologize. You can see there, right? So now this is going to reflect from here. 20 and 10 are ready to go up. So that means we can potentially go up here as well. And then looking at the oscillator on this, this is a extremely good oscillator. Well, these are everything is homegrown here, so yeah. So potentially the minor cycles are very on this stock S&P itself. It is right to go up as well, right? So as you can see now, will it really go up very hard? We don't know. Well, cycles are saying there's a potential, right? So this is where it is. So now it's some energy has to come and ping and push. This is where the astrophysics comes into picture, where we can see the energy map and say, hey, where are you unleashing the energy and when? So that gives us a time window. This is how we told 214 is coming, and it came. Now, if you check how far you're going and what time frame and how far you will go from that time frame, there's a lot of work. But let's see how things flow first. And then I think so. Now, with this same idea, same philosophy, within this context of these bigger cycles, it will be good to check for a given stock what is the correlationship between these cycles and in stock, because they can run on their own cycles. And what are the windows of stocks run up next 1 month, 2 months? We have to look back maybe at the beginning of the IPO to look at the energy map and say which weeks, and based on what market conditions, we have to look into astro maps and say, hey, this was the energy on this week by week by week, month by month by month, and how it behaved and what are the pattern matching has to happen, right? So that level of sophistication will take time to build, but we have some ideas. But this is where we are. So it is always good to keep an eye of the cycles. As you can see, this can go back 20 years. You will see a lot of correlationships. Not every cycle will just work exactly like this. Otherwise, if you just look at the 10 was mostly a refinement. Once you have taken a bias, I'm looking for long only. Then I'm looking for this guy to until this goes from short side, sorry, from the trough to the peak, we can just be in a long bias. So when it is going sideways, and this guy may be pulling back in the right to go in the direction it wants to go in the higher cycles, this can be a better way to refine the data entry also. For example, right here, right? Both want to go long. 10-20 won't make much a difference, but so this is what it is. Now, again, as I said, we are tracking not one market. We are tracking the entire suite. This S&P 500, Nasdaq, whatever, 25, 3000, and then NYSE, same amount, right? Largest volume stocks. So they all independently tracking, and when they all align together, entire market aligns together, we have a bias. So this is how what bias could mean in the context of 10 inside 20, 20 inside 50, and 50 inside multi-year cycles. Thank you so much, and we'll get back with more actionable ideas. Keep an eye on volatility reactions in the market. We will be creating a stock-based reaction to the market, intermarket stocks. If you're holding 5 stocks, which one is diverging across the intermarket volatility for the stock, we can look into those and see if we can have better protections. That's all there is to it. Thank you so much.